market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the ECB Forum on Central Banking in Sintra, and these are your top stories. Christine Lagarde says the ECB is becoming more resilient to economic shocks, while Philip Lane, its chief economist, tells us the central bank will not lock itself into a path for rates. As central bankers gather in Sintra, inflation concerns remain over the Iran war, with the top official from Tehran saying the country wants to retain control over the Strait of Hormuz. Plus, we speak to Jim O'Neill, former UK government minister, on his role as advisor to Andy Burnham, the man set to become the next prime minister. Now, first thing is first, we check the markets, as always, and we're seeing a little bit of a reprieve. Certainly when you look at the things that we're watching out for, U.S. stocks set to finish the best quarter in 6 years. Now, global stocks seem to have shrugged off any kind of concern about this armed conflict in the Middle East and the biggest oil supply shock on record. They're rallying back to this war-driven lows reached towards the end of March. I'm looking at Brent crude 72.51, NASDAQ futures gaining 0.2%. Now, after gaining some 14% since April off the back of this historic rally in chips, if you look at futures, they're still rising, and I think there's also a similar gain on the S&P 500 futures. Now, monetary policy and discussions on reviving the European economy, of course, are set to dominate the agenda here in Sintra. We repeatedly heard business and policy leaders talk about two realities. One is the AI revolution, with U.S. stocks heading for their best quarter since the pandemic. The other, the supply shock from the Iran war and increased trade tensions. Well, opening the forum last night here in Sintra, Christine Lagarde, the ECB president, said the region, the Eurozone, has become much more resilient to a range of economic challenges.
The euro area has also weathered the largest US tariff increase in almost a century, as well as what the International Energy Agency has called the largest oil supply disruption in history. That didn't go without a significant cost. It has been substantial, but the economy has not been derailed.
Well, a little earlier, I also spoke to Philip Lane, the ECB's chief economist, and he told me knock-on effects from higher energy prices will actually take a while to show up. He also says policymakers won't lock themselves into a path for interest rates.
I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like, fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty.
Well, we're now joined by Torsten Slok, chief economist at Apollo. Torsten, thank you so much for joining us.
Thank you.
Look, it's very clear the ECB keep on repeating they're data dependent. It's meeting by meeting. What are you expecting from them this year?
Well, the key issue also to what Philip Lane just said, and of course also what Lagarde said yesterday evening, is that now, of course, oil prices have actually come down quite substantially from even when they had their last meeting. And this is, of course, changing the outlook a bit, because this was a very important reason why they did do the hike at the last meeting. So the ECB, of course, is now looking at a situation where what they will pencil in terms of energy prices is probably quite different from what they looked at when they put together the forecast before the last meeting. So a very important backdrop is that energy prices coming down has changed the outlook quite substantially.
Yeah, so do you think, but actually you still have these second round effects. I know Philip Lane was saying, look, we're not exactly sure until when they last or how long they last, but do you think the ECB is now done with hikes?
So I do think that they will probably still think about hiking rates in September, and I still think that there is a highest likelihood that they will hike in September, because it is indeed the risk that the second round effects or the second order effects coming from companies that now are adjusting to the higher energy prices that they saw in the spring, that now they are going to be implemented, and that of course runs the risk that core inflation could be under some upward pressure.
But Torsten, why wait? Why not do it in July and then see?
Well, I think that she also made at the dinner yesterday evening here a big deal out of exactly saying that this was not an insurance hike. This was indeed a real hike, trying to keep inflation under control, try to limit inflation expectations, and implicitly also try to limit wage expectations. So that's why I think that they are proceeding very, very cautiously here by saying we don't quite know what the second order effect would be, and therefore let's just take one step at a time and therefore one meeting at a time.
Look, the star of the show is really Kevin Wunsch, because this is the first time that we get to meet him. It's his first travel abroad since being appointed as chair of the Fed. What are you expecting from him?
Well, the interesting thing about his last press conference is this was actually much the same as what we just heard from Philippe Lane and Christine Lagarde, because he's also saying we don't know exactly how the shocks, especially from energy prices, is going to play out. So for that reason, I think he's going to proceed also very cautiously. Markets are pricing that the Fed will be hiking rates in September, but at this point, if energy prices are now coming down very substantially, which they are and may continue to come down, then of course that will also change the calculation for them in terms of how worried should they be. So at this meeting, of course, he is going to talk at the panel tomorrow afternoon. It will be very interesting to see, especially now he's on the stage together with Christine Lagarde, how he talks about monetary policy in the US relative to Europe, and especially this issue about what is his communication. He has clearly said he does not want to give forward guidance. The ECB is still cautiously giving some forward guidance, but at the same time not providing much guidance in terms of exactly how they will think about the second order effects, because it could be that the second order effects are going to be small or big, and they will act correspondingly. So in that sense, it's consistent what Kevin Wunsch is saying, and also what Lagarde and Philippe Lane have been saying.
Are market participants still trying to figure out whether he's really a Trump man and a yes man?
Yeah, I think he very clearly told us at the last press conference that he is certainly a man that is going to stick to the Fed's mandate. And the Fed's number one mandate, of course, is price stability. That's also a secondary mandate, of course, of full employment. But he clearly said that his priority was we need to get inflation down. We need to fix it. Inflation in the U.S. has been above the 2% target for 5 years in a row. And he clearly was committed to keeping inflation at 2% or keeping price stability in the U.S., which was and continues to be the main target of the Federal Reserve.
Torsten, I'm a big fan of your research also, because you go back, to historical charts that we hadn't thought about to kind of give us an explanation of what's happening now. How do you look at energy? Because it's unclear to me why we're expecting such a big fall when you have a memorandum of understanding, but actually militarily you don't really know what happens next.
That's true, and that's also why the news today, of course, also is now bringing back to the table that maybe energy prices are coming down, but of course there is a risk that if we suddenly have another closure of the Strait of Hormuz, that then energy prices, of course, could begin to go up again. But it's very clear the market has made up its mind here and said this is going to be a situation where this will all be fading more and more into the background. That's why energy prices have been coming down. So for that reason, it must also be the case for both the ECB and the Fed that they begin now to plan with the view that energy prices are probably on the other side of the big hump that we have seen here for the last several months.
So how quickly are we, or how close are we to a possible cut from both the ECB and the Fed?
Yeah, so now that also becomes a function of the general economic backdrop. And of course, in the US, we have an AI spending boom, which is very strong. We also have the One Big Beautiful Bill, which is also contributing significantly to GDP growth. Those forces of growth are not really sensitive to interest rates. That's very different from in Europe. In Europe, we have that there are some other forces that are sensitive to interest rates, namely the auto sector and the housing sector. And that's also the case in the US. But in Europe, we have more defense spending. We're also spending on energy transition or renewable energy. So in some sense, the outlook is actually quite strong, both for the US and Europe. And that's, of course, why you begin to ask, well, why should the Fed and ECB then cut interest rates if we still have strong tailwinds to growth overall? So the bottom line is we still expect that interest rates will be higher for longer. And we still therefore expect that both the US economic outlook will continue to be good and the European economic outlook also in particular helped by spending on long duration assets such as defense and also energy transition, which require long-term financing and are very important reasons why the US outlook and European outlooks continue to look well, because we have these tailwinds at the moment.
Torsten, I mean, tomorrow we also hear from Governor Bailey, of course, on the panel. This is a tricky time for the UK, given everything that's going on with the Premiership. We expect Andy Burnham to become the next Prime Minister. How do you look at how tricky it is currently, given not only market pressure, but actually what the government is doing to set monetary policy for the UK?
And I think also for the UK and the Bank of England, this is also a situation of wait and see. In some sense, the Wunsch is saying wait and see for how big is the AI boom, what's going on with inflation. The ECB is saying wait and see because how big are the second round effects, and the Bank of England is also seeing, well, let's wait and see because we now need to understand what are the implications of the political changes that we're seeing in the UK. If we, of course, get a political change that's going to have fiscal policy in a different place, well, then the Bank of England also needs to think about how do they want to calibrate policy in response to that backdrop.
Can the AI boom in the US be infinite? I know you were also looking at, you had a great chart looking at margins that companies outside AI couldn't grow their margins that much in the US.
Yeah, and this has become a very important part of the conversation about the sustainability of the US economic outlook, that we had at the moment, US GDP growth is normally 2%.
Yep.
About 1 percentage point in the US comes from the AI spending boom. So the AI spending boom is a very important reason why the US is doing so well. So that's why this discussion around token optimization, model routing, and what are the costs of using AI for companies has suddenly become very important, because now the question, of course, becomes, well, what are going to be the revenues, and where the revenue is going to come from, who will pay the bills, and if you at the same time have Chinese models that are coming in at a much lower cost, in some cases 50 times less than the cost of US models, then this raises questions about, do you want to upload your stuff into Chinese models relative to US models? So there's a lot of things that are still uncertain, but at the end of the day, let's just agree that the demand for compute is, in my view, basically unlimited. So that's why we do need to build the data center capacity. We do need to build the computing power that's required for the future in AI. But the question is, are the implicit earning assumptions in the AI companies, are they going to be met, or is it going to come slower? In other words, the revenue is coming slower relative to what's priced into markets at the moment. So we may have a bumpy road ahead when it comes to AI valuations, but there can be no doubt about it that AI will be a revolutionary technology, not only for the US economy, but also ultimately for the European economy.
But Torsten, how do you look at that? Because actually we're also hearing a lot of chief executives saying, look, my staff are spending so much money at the moment on digital tokens that I'll have to put a stop to it. When does that come, and is that when we could see a reversal of some of these stocks and valuations?
That's exactly right. The conversations at the moment are a lot around this issue of how much money are we spending on tokens, because before the models did not require payments for individual tokens, but now suddenly here starting in April, several of the models are now saying, well, now you need to pay for tokens. So that's why companies are beginning to realize that the spending on tokens has been very, very high. The good news is that token prices are coming down, so that's of course helping, but at the same time this also begins to raise questions around, well, what is then the revenue source if companies are no longer paying for tokens to the degree that they were before? So these are exactly the discussion points around this issue of what is the trajectory of AI. The number one premise is AI will absolutely again revolutionize so many different things for households, for businesses, in so many different ways. But the key question becomes, are the market prices in terms of assumptions about what's assumed about earnings for AI companies, will it come as quickly, or is there maybe a scenario where it might actually be coming slower? And that will then begin to raise questions about not AI as an asset class as such, but really about individual parts of the AI spectrum, namely who are then the winners, who are the losers, if the revenues end up coming a bit slower, as per the discussion about tokens at the moment.
But Torsten, if you have a big market correction, you can also feel it in the US consumer.
Very importantly, because a key driver of the consumption at the moment in the US is the high-end consumer, and the top 20% of incomes in the US, they account for 40% of consumer spending. So that means that given stock prices have gone up, home prices have gone up, and also the cash flows you get in fixed income when interest rates are higher for longer has also been the best it's been in decades. So high-income households are making money not only on equities and on home prices, but they're also making money on their cash flows in private credit, public credit, fixed income. So for that reason, high-income households have done really well and continue to do really well. So that's why if the stock market were to see some correction, as we're seeing in the Magnificent Seven at the moment, then we would potentially see some problems for the US consumer. That's why, to your point, Francine, earlier, that the S&P 493, meaning outside of the Magnificent Seven, it's really important we see profit margins go up. It's really important we see earnings growth continue to go up, because then that could hand over the baton coming from the Magnificent Seven to the S&P 493. And that's what's very important for the economic outlook in the US, namely we need to see AI spread so that it's not only a part of the AI and tech sector, but it's also a very important part of the broader economy.
Torsten, thank you so much, as always, for joining us. That was Torsten Slok, the chief economist at Apollo. Now, coming up, Andy Burnham, likely to be the UK's next prime minister, makes big policy promises, but says he'll stick to the fiscal rules. Well, we'll talk to one of the most senior economic advisors of Mr. Burnham. That's Jim O'Neill. He's coming up next, and this is Bloomberg.
I am going to do things differently. I am going to break with the more of the same approach that has got us here. I am going to give Britain the circuit breaker it needs. By building a more collaborative politics in Westminster, by taking power out of the centre and putting it in the hands of the people and places who can use it best.
Well, that's, of course, Andy Burnham, the man who wants to be the UK's next Prime Minister. He's pledged to devolve fiscal powers away from Westminster and the big house-building programme while adhering to the current fiscal rules. Well, Jim O'Neill is a former chairman of Goldman Sachs Asset Management. He worked alongside Andy Burnham at the government's Northern Powerhouse Economic Initiative and is now one of his key economic advisors. And I am delighted to be joined by Jim O'Neill. Jim, thank you so much, as ever, for joining us. What are some of the things that Andy Burnham is thinking right now? I know there's a lot of policy to get through. What do you think will be his biggest challenge in getting things done when he gets to number 10?
I can't resist in saying, Fran, looking at where you are, one of the things he might be thinking, if he were watching this like me, is he wishes he was there. It looks like you're in some very exotic location. Anyhow, listen, what Andy unveiled just today is a sort of dream for people like me and those who were on the Cities Growth Commission I led in 2013-14, probably for the likes of Michael Heseltine, Greg Clark, George Osborne, of course. This should be thought about as almost constitutional economic devolution. I emphasise that I've seen a lot of people making reference to the devolution in Scotland and Wales, and their economies haven't done very well. That's because they don't really have any powers in big places like Glasgow and Edinburgh and Cardiff. This is all about economic devolution, and I've tried to talk to you and many others about it for many years. Greater Manchester, who led it in terms of pushing for some, has demonstrated it can work. That Manchester's grown, Greater Manchester's grown at 3 times the rate of London for 15 years. And if you can replicate that across 3 or 4 other big urban places, it's enough to, from a weighted population and GDP size, to boost the national growth trend. So I don't understand why the skeptic, I guess the skeptic's always about everything these days, but if you can replicate the same thing in more places, it's going to definitely improve the economic performance of the country.
I mean, how could funding, for example, more infrastructure in the regions work?
So one of the other things I've been talking about for quite a while, tried to persuade the Treasury under the current Chancellor, Rachel Reeves, about this, is this entity NISTA, which is the merged body from the old Infrastructure Commission and the Infrastructure Project Authority inside the Treasury. That should be not in the Treasury. It should be a sort of infrastructure version of the OBR, in which we have this transparent body that is telling the whole population and all the financial markets about the infrastructure projects that are likely to have very strong positive multipliers on the long-term economic performance of the UK, and with it, importantly, therefore reducing our debt levels and raising the OBR's long-term growth projection. And the government of the day, whether it be one that Andy leads in a few weeks or others in the future, choose to borrow or not to implement and fund project X or Y. Right. And I think the bond markets would be extremely happy with that, as would probably be the equity markets.
Jim, I mean, Andy Haldane had this idea also of splitting Treasury into a separate growth or a department of growth. Would you be behind that idea?
No, I don't really. I think this criticism that I've heard from a lot of members, various factions, typically more left of centre, about the Treasury. From my own experience, it demonstrates a lack of awareness of the realities of how the Treasury functions inside and across all the other departments. And for that matter, as I've said to a couple of people when I've been in this discussion in the past week, tell me an economics ministry anywhere else in the world that actually has any influence on their growth rate. You know, I know from my own experience, if you get a leader of the country and a chancellor that's aligned with them on making it clear what their priorities are, the Treasury immediately jumps to, as they should do as civil servants, to delivering what is expected of them. And I saw it when I went in to deliver on the Northern Powerhouse under George Osborne. The devolution department that didn't exist before became one of the most favourite places for aspiring civil servants to work at. And that's exactly how it should be. So you just need to give clearer confident mandates and leadership to the civil service staff, including the Treasury. But breaking it up is, from what I can see, pointless.
So who's the right person to be Chancellor?
Like I keep saying to everybody, Fran, and I might have said it to you before, I don't think that is the right question. Andy gave a hint of a strong flavour of where he wants to go. Between now and whether he, when and whether he becomes PM, he's got to really clear up on all those priorities, make it very, very clear to anybody that's going to be in his government, including the Chancellor, that is what he wants to have delivered. And then he decides to find the right people to deliver it. All this sort of obsession as to who's going to be Chancellor, when, importantly, by the way, he's not in a position to appoint anybody, is sort of madness. And I think it's the wrong question people are asking.
I know, Jim, but as you said, it's important that actually it's a two-person team, right? The Prime Minister and his Chancellor. And so is there a specific type of person that needs to reassure the markets, that needs to reassure, the bond traders that they're ready to act, but, don't do nonsense with fiscal? It's the two of them that need to reassure the world in this, that they can achieve growth whilst, not have a market event.
Kind of, but as I sort of said at the start, I think a lot of your viewers and listeners, that they're going to have to go through a mindset change here. Andy is going to introduce pretty significant changes, as he talked about yesterday. And there's going to be a lot of devolved powers, and it's going to change the nature of things that influence what's going on in the country. And with it, and certainly through my adult lifetime, we've had a pretty reoccurring history of the Prime Minister of the day and the Chancellor never really seeing eye to eye. And the key thing, and by the way, in the 5 weeks now since the Makerfield by-election, the UK gilt market has actually outperformed virtually every other market. Now, there could be other reasons for that, and of course it started from a weak position. But I think that relates to the credibility at the centre. And if you've got a Prime Minister that's really going to change things and be successful in raising our growth trend, then of course the Chancellor is probably the second most important person. But he's got to have everybody in his cabinet, and for that matter, ministers below and all the civil service machine, all understanding the sense of direction which is being set at the top and is credible. And yeah, of course the Chancellor's important, but you can't have a choice of somebody that the financial markets love just because of some notional view they love him or her, and it not being in line with what the Prime Minister of the day is trying to do. It just, it's the wrong question that I see so many people talking about all day long and constantly asking me, even though, of course, as a crossbench peer, I've got absolutely no influence on any of those decisions.
Yeah, and I want to get to that in a second, but Jim, do you see wealth taxes or some kind of, equalizing of capital gains tax to income tax being good ideas?
I think these are choices that Andy's going to have to make. Let me make that clear. In my own opinion, and I've made it pretty clear elsewhere, to really improve things beyond the excitement to do with devolution, Andy's got to deal with some of the tough spending issues. And very importantly, and it's not really been picked up yet, he made some pretty clear comments about tackling welfare reform yesterday. And I know from my significant involvement with the Greater Manchester team that's going to be an important part of Number 10 North, that's front and centre of how they're going about things. And so if the markets start to really understand that, and we get more of this credibility that seems to be creeping back into the gilt market, I don't really see why there would be any need for further tax increases. We've had a lot of tax increases. And I do not believe, the one area in particular that I strongly oppose is the so-called equalisation of capital gains tax, especially for venture capital. I'm heavily involved in that in the chairing of Northern Gritstone, which, by the way, Greater Manchester Combined Authority is an investor in. And venture capital investing is an exceptionally risky thing, and people can lose all their money. So To regard that as the same as income tax is just not very wise at all.
All right, Jim, as always, thank you so much for joining us. Jim O'Neill, their economic advisor to Andy Burnham, and of course, former chair of Goldman Sachs Asset Management. All right, we're here in Sintra, Portugal for the ECB forum. Coming up, we'll speak of stability, financial stability with the IMF. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra, and these are your top stories. Christine Lagarde says the ECB is becoming more resilient to economic shocks, while Philip Lane, its chief economist, tells us the central bank will not lock itself into a path for rates. As central bankers gather in Sintra, will inflation concerns remain over the Iran war, with a top official from Tehran saying the country wants to retain control over the Strait of Hormuz. Plus, Andy Burnham vows to radically devolve fiscal powers from London if he becomes the next prime minister. His advisor, Jim O'Neill, tells us there will be a mindset change under Burnham. Now, the ECB remains concerned about inflation despite oil prices slumping on progress towards peace between the U.S. and Iran. Well, officials raised rates by a quarter point this month, the first hike since 2023, and markets are betting that they'll do so again by the end of the year. But the bank's chief economist, Philip Lane, has told us officials are not boxing themselves in a path for monetary policy. I asked him what's changed since the ECB's recent hike.
For the economy, it's only been, a few weeks. So clearly what's changed is the oil market. And that is moving quite a bit in the weeks since we've made our decision. And so let's see how that percolates across the economy. So what we have seen is in terms of confidence indices, there has been some improvement, but not a return to the pre-war levels. So it's not the case that there's been this very rapid rethinking of how investors and consumers feel. I mean, I think probably they need to see this current peace agreement convert into something more durable. And as you know, every day there's, plus and minus signals. And that needs to settle down, I think, before consumers and investors take a more decisive revision of their views.
I mean, this is really the concern, right, is that we're not really sure what these ongoing talks will bring. Madame Lagarde yesterday was really talking about no forward guidance, but scenarios. So with these ongoing talks, are we closer to the milder scenario or base scenario? So
I think the most important fact that we see is right now the oil prices reverted to pre-war levels. Yeah. But the view of the market in terms of 2027 and 2028 is that it will be well above pre-war levels. So in other words, over the next couple of years, maybe because around the world energy firms, governments will want to rebuild inventory, that maybe demand for oil for restocking purposes will keep the oil price high compared to the pre-war level. So from our point of view, it's very welcome that we see this decline in the price of oil, but in terms of the overall inflation impulse, the fact that we do have maybe for a couple of years oil prices above the pre-war level, that essentially is a cost-increasing impulse to the economy. So it's very clear that the ECB wants everyone to know that the last hike was not an insurance hike. Will the next hike be an insurance hike? So I think it's important that we are clear on our terminology, if you like. So as President Lagarde said last night, we feel that the June decision was a robust decision, that we looked at it from every angle, and even from the angle which we did anticipate of having, if you like, this more rapid decline in oil prices, even under that kind of more rapid normalization, it made sense because of 4 months of high oil prices to raise the rate from 2 to 2.25. What I think is important to say is as we go forward, as we evaluate the kind of pros and cons of different rate decisions, we will be, if you like, mainstreaming the concept of how does this decision look like under uncertainty. Yeah. Now, for me, I would reserve the phrase insurance hike to a situation where there's a tiebreaker, that maybe you could at least stay where you are maybe you could hike and the risk considerations will push in one direction. But that was not the June decision. That was a clear decision, robust across a wide range of scenarios.
Yeah, I mean, given the wide range of scenarios and the uncertainty and the second round effects, is it better to hike in July or September?
Well, again, the way you phrase that question is maybe overly narrow. So what I would say is, before we get to the second round, I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like, fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty. And it's essentially the tension between these many firms have been absorbing higher cost increases for a number of months. Whether they can recover those cost increases by raising prices, or whether, especially in the context of now the fuel prices reversing, it's absorbed in profit margins and it's less by way of the indirect effect. And only after that can you start to have a vision of how strong the second round effects on wages might be, which would be later this year and into next year.
So you're telling me my question is too narrow because you could not hike at all?
I think, as you very well know, we're very much committed to basically going one meeting at a time, to not boxing ourselves in by kind of speculating about rate decisions, and essentially focusing on, at the time of the meeting, when we look at everything, what makes sense.
Philip Lane there, the ECB's chief economist, speaking to us a little bit earlier. Now, beyond inflation, the impact, of course, on AI on productivity, another key theme here at Sintra. Well, the International Monetary Fund is warning that AI-related cyber attacks pose risks to financial stability. So let's discuss all of this with Tobias Adrian, financial counsellor and director of the Monetary and Capital Markets Department at the International Monetary Fund. Tobias, thank you so much for joining us. We'll talk a little bit about financial stability, AI, and maybe some of the cyber attacks and monetary policy as well. I mean, when you talk about cyber attacks, does it have to increase spending of companies, but also institutions, to try and make sure that this doesn't happen?
Yeah. So let me make 2 points. So the first one is that we have already seen a compression of time in between the discovery of a vulnerability and the exploitation of the vulnerability via an attack. So this used to be several months. Now it's within the first day. The majority of the attacks are happening, within minutes. So a tremendous increase in the speed of attacks. Yeah. New AI models basically accelerate that further. So the question is, yes, you can use it for defense, but it can also be used for attacks. And what's the balance?
I mean, this is the problem with mythos, right? And I know a lot of the European banks, a lot of the smaller U.S. banks are also a little bit mad that they haven't been able to look at the models, so they don't really know what defenses they need to put in place to make sure that they don't have these attacks. Yeah. Does this level out?
Yeah, absolutely. I mean, it's hard to see how this is going to level out across the world, right? I mean, there are some companies that don't have the same capacities of major banks or major technology firms. They wouldn't be able to afford this cutting-edge technology, and they may not have the capacity to translate it into effective defenses. So I do think, from a global point of view, there's certainly a rise in the cyber vulnerabilities.
What do you think is the single most important issue for financial stability across the world?
Today, the one thing that worries me, and that's more of a medium-term issue, is the interconnectivity between fiscal fragility and financial stability, right? We have seen debt to GDP go up globally, not in any one country, but across the world. It's approaching 100% debt to GDP. And so the question is, how fragile is if adverse shocks hit?
We've been talking about this for years, right? We've been waiting for some kind of market event in treasuries. We've been waiting for the same in the UK. Is there someone that's more at risk given the market functioning?
I think countries in general are more at risk from having some sort of dysfunction in longer-term bond markets. The financing of the longer-term bond markets has shifted from banks and insurance companies towards non-banks, other non-banks, leveraged investors in particular. And, this can be good for market discipline on the one hand, right? They are very active and they may put pressure on governments, to get their house in order. But on the other hand, they can also amplify downside shocks and become fragile.
But Tobias, we also need to find growth. And we just had a good conversation with an advisor to Andy Burnham in the UK. So if you have a new prime minister, president, we have elections in France, what's the right way of looking at this? It's fiscal discipline, but at the same time, you need your country to grow. So maybe you need to be bolder.
Absolutely. And I think what works are structural policies, right? I mean, what works to enhance growth, enhance the outlook are structural policies, but these are painful, right? This is reforming the pension system, reforming the labor markets, making the economy more flexible. Clearly, we're in the midst of a technological revolution, and we need to get countries ready to adjust to this new technology.
Tobias, if there's a kind of correction, right, amongst these big AI companies that are mainly in the US, would this be a risk to financial stability, also given the amplitude they have on the markets?
I will give you an on the one hand, on the other hand answer, typical economist.
So diplomatic.
Exactly. On the one hand, a lot of the investment of those firms is financed out of equities, right? And so when equity markets go down, of course, it has an impact on financial conditions. It does have some macro impact, but it's not like the collapse of a highly leveraged shadow banking system, right? Now, there is some leverage that is going up, so more companies are financing via debt, and there's some maturity transformation. So, there's a worry, but it's primarily equity for the moment. On the other hand, of course, we do see quite a bit of concentration, right? And I think the key question is about profitability. So is the profitability that has been very strong, has been outperforming expectations consistently, going to persist going forward?
But is there a danger that, central banks across the world don't really have a template for how this AI will impact inflation, productivity, even jobs, and so it could lead to policy mistakes?
So I think central banks, I have more faith than you in central banks. I think
it's just a question. I have faith.
So central banks have very powerful tools and they have very clear mandates, and they are looking at the world in real time. Of course, how the world is going to look like in 5 years, nobody can tell. But as time evolves, are we going to be equipped to sort of deploy our tools in order to meet our mandates? I think central banks are well equipped for that.
How do you think it will change our economies, AI?
So, it is very transformative, and it is work in progress. I think the word I would use here is enhancement, right? So we're getting enhanced via artificial intelligence. We're all getting more productive. And the economic processes have to readjust to this new technology. If markets are flexible, that can create a lot of opportunities. But you need to have the right backdrop in terms of the economic policy setting, particularly structural policies.
Tobias, thank you so much for joining us today. That was Tobias Adrian, Financial Counsellor and Director of the Monetary and Capital Markets Department at the IMF. Now, coming up, a $10 billion economic weapon to help Ukraine as the EBRD readies new funds for the country's reconstruction. We'll be talking to their chief economist, Beata Javorcik. That's coming up next, and this is Bloomberg.
My objective from the outset has been clear, to begin balancing the trade relationship between the European Union and China. The gap is widening. China's export to the EU keep rising, while our market share in China keeps shrinking.
Well, that was the EU Trade Commissioner, Maroš Šefčovič, speaking there after talks with the Chinese Commerce Minister. Now, a little bit earlier, I spoke to Olaf Slijpen, the Dutch central bank governor. He told us there's still uncertainty despite falling energy prices. He says policymakers will act accordingly based on the data.
Oil prices came down quite a lot. At the same time, we also have to acknowledge that there's still a lot of uncertainty around there. So let's see how it will develop. Obviously, energy prices coming down will have an impact on prices. At the same time, we see that the previous rise in oil prices already has its impact on the price level.
So how worried are you about second round effects? That without, even if oil prices go down, that these second round effects are here for longer?
We have to see. You know that we always say we are data dependent. We have our next Governing Council meeting end of July. Then we will have new data again. We will look at how the situation looks like. Decline in the oil prices now, of course, is from an inflation point of view definitely good news. But it remains to be seen what is still in the pipeline.
Is there a case actually for a hike in July?
I would like to refer to President Lagarde's speech that she gave here in Sintra last night, where she said we're not into forward guidance, but we are into framework guidance, which means that it's important that the markets, the analysts, the people understand our reaction function. Mm-hmm. And I think markets understand the ECB's reaction function pretty well.
Well, that was Olaf Slijpen, governor of the Dutch Central Bank, speaking with me earlier here at the ECB forum in Sintra. And actually, tomorrow will be 1 year since he's been in the job. Now, this morning, we've been discussing the need for further rate hikes in the euro area with the leading member of the ECB Governing Council. Well, the Belgian Central Bank Governor, Wunsch, gave me his thoughts on the need for action to fight inflationary pressure following the Iran war.
The market is still pricing one. But the way I would put it is, the origin of the shock being higher oil prices. To the extent you believe that there is now a truce and the prices will go down. So the origin of the shock has disappeared, more or less, before we see second round effects. Of course, there will be some. So that makes it, I think, relatively easy. We might need another hike, but in all likelihood, and that's of course what the market is pricing, but not as much as we thought in June.
But so if the Eurozone does need another hike, is it easier or better to do it, quicker, so July rather than September?
I would rather, if we believe we need another one, move quickly. It doesn't mean July, but there is always value to it because you have more information. But if we believe that now it's going to be, less pressure in the economy because oil prices go down, if you wait too long and then you have one surprise in one direction, one surprise in another one, you end up doing a hike, and then maybe you have three surprises on the downside. Now we know inflation is going to be above target for a number of quarters. So if we need to do another hike, if the data show that it's required, then I would not wait for too long.
That was the Belgian Central Bank Governor and ECB Governing Council member Pierre Wunsch. Now, the war in Ukraine is well into its fifth year. While the fighting goes on, the European Bank for Reconstruction and Development says funds pledged to the bank for Ukraine's resilience and reconstruction have now surpassed $10 billion. Well, Beata Javorcik is chief economist at the EBRD, and she joins me now. Beata, as always, thanks so much for joining us. So tell us where we are exactly on Ukraine and what the EBRD has pledged so far.
So we have pledged extra €500 million at the Ukraine Recovery Conference a few days ago. That brings the financing we deployed since the beginning of the war to €10.5 billion. We are supporting energy sector. The new funding will go for repairs of some of the substations, but also for improving governance at Ukrenergo, including strengthening anti-corruption efforts. We are also going to finance additional wind generation of electricity, some battery storage, and of course support for micro, small and mid-sized enterprises through our risk-sharing facility.
Beata, we've been talking about inflation, of course, the volatility in the price of oil, and the fact that even if oil prices are expected to come down, we don't really know what comes next. How does that complicate things for some of your funding projects?
Well, so in Ukraine, the situation is challenging not only because of the destruction of infrastructure, energy infrastructure, but also high prices of energy are putting pressure on the real economy. And that's why we are focusing our efforts on the real sector, on supporting small firms. We also offer some subsidized insurance, and some of firms that will receive these credits will be eligible for debt relief if the assets supported by us are destroyed through war efforts.
The concern is actually how far away are we from rebuilding, because there's no real end in sight for the fighting. How do you, I guess, speak to investors about that?
Well, that's why our risk-sharing facility is designed to help micro, small and mid-sized firms to invest in sort of longer-term assets. And it's also done with an eye on helping them use more renewable energy, comply with future European norms with an eye on future accession to the EU. So it's about taking a long-term view under very difficult circumstances.
I mean, how's it going in Central Europe right now? We were both in the dinner last night where Christine Lagarde gave a speech that was actually fairly optimistic about the prospects for the Eurozone, talking about financial stability, but also opportunity. But then it's underlaid with, again, all of this geopolitical concern,
as well as energy costs. And in Europe, the story is about high prices of natural gas. These prices are multiples of prices in the US. And it's the second energy shock we are experiencing after 2022. And what you see is decline in output of energy-intensive industries in Europe. And you already see it clearly in the data in Germany, in Western Europe, in Eastern Europe as well. And of course, high electricity prices do not bode well for setting up data centers in Europe. There was just a talk where the figure of 5% was mentioned. Europe owns 5% of global data centers, while our economic weight suggests it should be more like 20%.
What do you see as the biggest barrier for the EU right now? I know we've talked about energy prices in general and the fact that there's also not a really common energy policy in Europe. Does that need to change for Europe to grow?
So I think what we need is to focus on long-term issues. So there are many challenges we are facing in Europe. High energy prices are one, innovation, competitiveness and pressure from trade, and of course, demographic trends. Now, all of these challenges can be addressed, but they cannot be addressed fast. And that's why we need to act now.
But this is a problem of Europe, Beata. I mean, in a crisis, usually Europe gets together. Do you see that moment now?
I hope that's what will happen, because, you know, the uncertainty, the series of shocks we have been experiencing create an overload. Policymakers need to deal with the news of yesterday, with the prospect of another change in policies tomorrow. And that means that there is little time and, frankly, bandwidth for focusing on solving long-term problems.
Do you see, I mean, some European countries coming together? I don't know whether you focus a lot also on regulation. Certainly Europe has stuck together to deal with Ukraine.
Indeed, and I think, you know, the Draghi agenda is being implemented, perhaps not as fast as we could have wished, but I think the second energy shock has also focused mind. We need to do something. We need to do something about grid, about storage, about speeding up permitting. We need to think about not being left behind in the AI race. And that means faster permitting for data centers, for instance.
Beata, everything's changed actually with Germany spending, but we're not really, you know, seeing the benefits until I think 2027. Does that also change the fortune of Central Europe?
Of course. What happens in Germany is affecting demand for exports from Eastern Europe, and it's not only the supply chains, automotive and machinery, it's also demand for software, it's also demand for consumer products. If the German economy is doing worse, there's less demand for anything from food to furniture. So the economies in the region that are doing well are economies like Poland that are more diversified, that can also benefit from their own demand. And of course, the big question everybody is asking is, we had European RRF funds. There is investment in security, in defense. Now, what kind of public investment will drive growth going forward?
Beata, as always, thank you so much for joining us. It was Beata Javorcik, we'll get it right, the Chief Economist at the European Bank for Reconstruction and Development. Now, we'll have plenty more, of course, from Sintra throughout the day. Don't miss our interview a little bit later with Olli Rehn, the Bank of Finland governor. That's at 3:40 p.m. London time. And the Pulse is back in Sintra. Also, tomorrow, we'll be speaking to Joachim Nagel, the Bundesbank president, plus our exclusive conversation with Leseya Kganyago, the South African Reserve Bank governor. Up next, it's Bloomberg Brief, and this is Bloomberg.